S&P 500 September futures are slipping 0.10% right now. Nasdaq 100 contracts are down 0.13%.
Right.
It's Monday morning, June 22nd, 2026, and the opening bell has not even rung yet.
And looking at the implied open, it's giving us this deeply defensive, really low volume holding pattern across the board.
Yeah, I mean, volatility is tightly compressed. The VIX is sitting down at 16.7 this morning.
Which tells us the overnight session is essentially just a coiled spring. The broader market is completely holding its breath.
Okay, let's unpack this. Because if you are an everyday retail trader looking at this tight pre-market volume and, expecting a smooth, soft landing today.
You might be walking directly into a buzzsaw.
Exactly.
Mhm.
Institutional flows show that the smart money is bracing for a much harsher macro reality. Our mission in today's deep dive is to decode these hidden structural forces hitting the tape before the open.
And before we get into the pre-market volume on specific gappers, we really have to isolate the overarching macro weather.
Because right now, that weather is incredibly messy.
Oh, totally.
It's being driven entirely by a hawkish Federal Reserve and this totally fractured geopolitical crude oil dynamic.
Right, you really can't trade a single tech stock today without mapping out the overnight bond yields. The market is clearly still digesting the Warsh effect.
Yeah, the new Fed chair, Kevin Warsh.
Exactly. Following his hawkish surprise last week, the market is dealing with a massive shift. I mean, 9 out of 19 policymakers actually expect an interest rate hike this year.
Not a pause, a hike.
Right, and the overnight swaps are already pricing in a 50% probability of that happening.
But the data driving that hawkishness is just totally contradictory.
Right.
Looking through today's institutional strategy report, there's a glaring contradiction regarding the U.S. and Iran peace talks.
Yeah, specifically how it impacts crude oil prices, which, dictates the inflation metrics the Fed looks at.
Right. So on one hand, one part of the report notes encouraging progress in these Swiss-mediated talks.
They even mention a 60-day roadmap.
Yeah, which is easing crude oil prices down to the $54 to $79 range.
Which naturally cools those inflation fears.
But then you turn the page, and the exact same report states those talks totally stalled over the weekend.
Right, and now Iran is threatening to close the Strait of Hormuz.
Which handles 20% of the world's oil supply. That instantly stokes energy shock fears.
Oh, absolutely.
It's like driving a car where the GPS is telling you to take a left into a lake.
Yeah.
But the passenger is screaming that the road is perfectly clear. I mean, how does a trader even operate when the core data points contradict each other so heavily?
Well, what's fascinating here is that this contradiction is exactly why smart money is just systematically pacing itself.
They aren't trying to guess the headline.
Exactly. Macro funds aren't flipping a coin on binary geopolitical news. They're waiting for Thursday's high-stakes core PCE inflation data to reveal the actual economic reality.
Because the PCE cuts through the noise.
Right. So with the macro picture so murky, the guaranteed market action today is entirely enforced structural buying.
Which brings us to the historic Nasdaq 100 and S&P 500 quarterly rebalance going live today.
Right. Passive index funds are mechanically forced to buy billions of dollars of AI upstarts.
Just mechanically executing market orders. So the S&P 500 is adding Marvel and Flex.
Yeah.
And the Nasdaq 100 is adding CoreWeave, ticker CRWV, and Astera Labs, ticker ALAB.
So what does this all mean?
Right. Is this setting up the next leg of the tech bull run? Or are everyday investors being led into a passive debt trap?
Well, you are buying highly leveraged upstarts right at the top of a tightening cycle. This forced buying completely overrides normal market fundamentals.
It just keeps the AI CapEx boom firmly in control of the tape.
Even while the broad indices are totally flat.
Yeah. The AI rebalance isn't the only tech story. Let's look at the pre-market movers. Capital is actively fleeing the energy sector because of that potential crude oil slide.
And rotating directly back into specific tech and pharma catalysts.
Like the memory supercycle. Western Digital, ticker WDC, is up over 5% pre-market.
Right, on the closing of their SanDisk share swap.
So they become a pure-play storage titan.
Exactly. And Micron, ticker MU, is dapping up over 3%.
Because Bernstein just raised their price target to $1,300.
Yeah, citing severe DRAM and high bandwidth memory shortages. And remember, Micron has their Wednesday Q3 earnings coming up.
The HBM shortage is massive. It's the absolute bottleneck for this whole AI rollout.
Right.
Moving on to GETY Images, ticker GETY, This is wild. Up a staggering 130% to $1.44.
Incredible move.
Driven by a multi-year partnership with OpenAI to power ChatGPT searches.
It's the ultimate pivot.
Yeah, if you can't beat them, join them. Instead of fighting AI in court, they're monetizing it.
For active traders, the technicals on GETY are key. $1.50 is the bull trigger for a run to that $3.35 fair value target.
But $1 is the crucial bear support. If it breaks below $1, look out.
Right. We also have APGE Therapeutics, ticker APGE, up 54% to $139.25.
There's a Financial Times report that AbbVie is in late-stage talks for an $11 billion buyout.
Yeah, for their anti-inflammatory drug Zumilokibart.
Support is establishing at 110, targeting 140 to 150.
And finally, Intel, ticker INTC, is up over 4% to $139.40.
Yeah, reports of expanding an Arizona partnership with the Taiwan's UMC.
Working on 12 nanometer and 3 nanometer processes to challenge TSMC.
Right. But the real risk here is that UMC hasn't confirmed this. If algorithms treat their silence as a denial, Intel will reject heavily.
Which perfectly illustrates the massive divergence we have to navigate this morning.
Oh, absolutely.
We have these massive single stock moves, but the overarching indices are barely moving.
I mean, how is that mathematically possible? How are traders supposed to navigate that?
The report calls this a coiling liquidity trap.
Right.
Aggressive buyers and sellers are literally getting chopped to pieces inside these really tight execution ranges.
Let's break down the exact technical setup for the listener. For S&P 500 futures /ES, we're trading flat near 75.54.
Support is 75.35 to 75.45.
With a hard macro floor at 74.20.
And upside resistance is layered between 75.78 and 75.90.
And for the Nasdaq futures /NQ, trading near 30,653.
The support line in the sand is 30,450 to 30,550.
And if it breaks 30,350?
It opens a trapdoor directly down to 30,000.
Wow. And resistance is capped at 30,750 to 30,800.
So the strategic play here is not to chase extremes.
Just play the tight ranges.
Right, until Thursday's PCE data triggers a real structural breakout.
Let's zoom back out for a second. If the market is trapped in this range, and the Fed is hawkish, who is sitting on a ticking time bomb.
Well, look at the macro squeeze. The U.S. 10-year Treasury yield is creeping up to 4.50%.
Yeah.
And the U.S. dollar index, the DXY, is up to 100.94.
Right.
If we connect this to the bigger picture, this is a highly coordinated headwind for tech.
Let's explain why. High yields mechanically shrink the present value of future tech cash flows.
Right. Exactly. It compresses those high multiples.
And a strong dollar completely eats into the Q2 profits of these multinational tech giants.
Which brings us to what the report calls the pain trade. Retail investors are falling into a twofold trap.
First is the bond route.
Yeah, retail is buying Treasury bonds expecting a Fed pivot. But if those Strait of Hormuz tensions spike the price of oil,
the 10-year yield could rocket to 4.65 or 4.75%.
Which would totally crush those bond positions. And the second part of trap is valuation capitulation.
Because AI and enterprise software are priced for absolute perfection right now.
Exactly. Rising rates and energy costs could spark a swift 10% tech correction,
forcing retail to liquidate, while cash and commodities outperform. It's literally like setting up a picnic on a beautiful beach.
Right.
Completely ignoring the tsunami sirens going off in the background.
Yeah, it's a very dangerous setup.
So, to quickly summarize the main threads for today's open, we have fiercely conflicting geopolitics.
A surprisingly hawkish Fed.
Massive forced AI buying keeping certain tickers afloat.
And a treacherous coiling liquidity trap waiting to catch overeager breakout traders.
Thank you for joining us on this deep dive into the institutional order flow and the underlying currents of the market. But before we sign off, I want to leave you with one final provocative thought to ponder.
Okay.
If passive index funds are mechanically blindly forcing billions of dollars into specific tech and AI stocks simply because of calendar dates and rebalancing rules,
Yeah.
completely regardless of these huge macro headwinds, 10-year yield spikes, or hawkish Fed policies,
Right.
Are we entering an era where the mechanics of passive investing have completely decoupled stock prices from underlying economic reality?
Does the index tail now wag the economic dog?
Exactly. Keep your eyes on the data, respect your levels, and we will see you on the next deep dive.